So with that, let us be in prayer. O Lord, for this day, we give you thanks. For the sun that we have not seen in a very long time. O Lord, we give you thanks. For this opportunity to be together, in person or virtually, we give you thanks. For this opportunity to be here with Meninga, who with their wise wisdom and wise words will help us navigate the often complicated world of taxes. O Lord, we give you thanks. We thank you, O Lord, for this opportunity to be with you, with one another in Christ, and always everywhere, to be your hands and feet in this world. In your name we do pray. Amen. Jason, do you have anything else?
No.
Fabulous.
All right. All right. Well, I will introduce myself. My name is James, and I have Cassandra here as well with me. So we are with Meninga Tax and Financial. We're a local firm here and in Madison, and we do both tax planning and financial planning. And our hope for today is to kind of bring to light a few things in the realm of preparing your taxes as a member of the clergy. So I will kind of piggyback on what was said already as well. Any questions, no need to hold them until the end. If you have a question, let's just, take care of it right away. I think it can be helpful as we're going through the material just to have those questions. So Jason, feel free as chats come in, just holler with them. At Meninga, basically there's 3 individuals who are going to specialize in the clergy taxes. Betty is now actually retired, so I should say with some of the tougher questions we sometimes feel the need to go and get her expertise. But Cassandra and myself are going to be the 2 individuals. So if you have any questions after this, you're always welcome. Give our office a call, maybe for your specific tax questions relating to your circumstance. And you're going to want to ask for either myself or for Cassandra. If you ask for anybody else, they won't have a clue what to tell you. So all right, so a little bit, this is just kind of the agenda for the day. We'll give you a little more info about us. We're going to go over specifics of clergy taxes, some stuff that is not related to clergy taxes. We're also just going to give you a couple extra tidbits there. Have plenty of time for questions too, and as much as possible, we're going to try and have fun with the riveting topic of taxes. So just a little bit more about the firm. We've been locally owned for over 30 years now. We're actually coming up on 35 years. I just have not updated this slide in a number of years. Marshall and Betty Meninga are the owners. We currently have a fairly large staff. Those numbers are also not updated, so it's actually quite a bit larger than that now, but we're somewhere near about 20 advisors total. Okay, so with that, I'm just going to jump right in to a couple of tax situations for pastors. So first thing is, I just like to remind everybody that clergy kind of have this dual tax status for taxes. First, going to be considered to be employees for income tax purposes. Okay, so what that means is that you're going to receive a W-2. You're not receiving a 1099. So receiving a W-2. You're going to report that just like any other taxpayer. It's going to go right on your 1040. Okay, but you're not reporting it as self-employment income like on a Schedule C. There's self-employment tax. We'll talk about that later. As employees, there used to be something in the tax code where you could deduct any unreimbursed expenses that you had. So if you bought books for your office or like anything else kind of office related, you got to deduct that against your income. Since 2018, you can no longer do that for income tax purposes. Okay. You can for self-employment tax purposes, and I'll talk more on that later too. But for income taxes, you're no longer able to reduce your income with those business expenses. With being an employee, you also are going to have many tax benefits that are offered by your employer. Okay, so that's going to be pre-tax flex plans. It's going to be medical insurance. Employer is going to pay for part of that. UMPIP contributions, both the you're going to have the ability to contribute into a retirement account for yourself, and also the church is going to make some contributions for you as well to the pension. You're going to have accountable reimbursement plans. So that's reimbursement. You have a certain amount that's allotted every year for mileage or other professional expenses. And then the big one, which causes a lot of confusion, is the housing allowance or parsonage allowance. Okay, so they work differently. So it just kind of depends on your circumstance on if you have your own home or if you have a parsonage. Is that me, Jason? Okay. Okay. We have, for everyone online, we just have a little bit of a noise in the room, that little bit of feedback, but we'll keep going. Okay, so kind of the flip side, the other hat that pastors are wearing is that they are going to be considered self-employed for purposes of paying Social Security and Medicare taxes. Okay, so they are considered an employee when we're talking income taxes, and they're considered self-employed for Social Security and Medicare taxes. Social Security and Medicare taxes are going to be paid kind of two different ways. If you are an employee, so just a standard employee, we're not a pastor, you're going to have Social Security and Medicare tax just deducted straight from your paycheck, and that's 7.65%. And then your employer is also going to pitch in another half of that. Okay, so they're putting in 7.65% as well. That's for the total of 15.3%. So when you're self-employed, like you are as a pastor, you are going to be paying both halves of that. Okay, you are both the employer and the employee in that situation. So you're paying the full 15.3%. That's all calculated on your personal income tax return. So it's a calculation that you need to make and include with your federal income taxes. So that is kind of the biggest difference between being self-employed versus being an employee, is that you're responsible for both halves. So a little bit more tax as a self-employed individual because your employer is not pitching in the other half. Just kind of going through an example of how we determine wages that are subject to income taxes. So once again, talking income taxes. For those wages, we're going to start with your gross wage. So second line on here. Actually, one piece I want to mention on the first line here. This is all included on your W-2 at the end of the year. The important part about this is we want to make sure that this is correct. So when you're preparing the W-2 or your treasurer is preparing the W-2, whatever is in box 1, the first box of that W-2, is going to determine, I mean, that's the number you take to your tax return. You may not know whether or not that number is correct. If you hand that W-2 to your accountant, they're certainly not going to know if that's correct or not. They just assume that it is. So it's a really, really important piece to make sure that the W-2 does get prepared correctly. So starting with the gross wage, you're then going to subtract off all pre-tax deductions. So pre-tax deductions are going to be your flex spending account. Okay. It's going to be if you had to pay any portion of your health insurance. It's going to be any contributions that you made to the UMPIP account. If you designated them to be pre-tax, you have an option to make them Roth as well. But that's going to be the first thing. Subtract anything that's designated as being a pre-tax deduction. And then you're going to want to subtract off the designated housing allowance as well. We'll get into that in more detail too. So, but that's going to get subtracted off of your gross wage as well. And then that's the number that goes in box 1. So subtracting all pre-tax deductions, subtracting housing allowance as well. Yep, Jason?
So someone typed in, what about clergy, and you're gonna have to repeat this. So folks can-
Yep.
What about clergy who are working for nonprofit agencies that are not directly employed by the conference or a church? Also curious about clergy living in other states because I'm in Michigan.
So the question was, what about pastors who are working for a nonprofit that is not directly the conference or a church? It's just a separate nonprofit that they're employed by. And also, what about pastors who are in a different state other than Wisconsin? So as far as states go, all states recognize the housing allowance and they recognize these pastor tax rules. So how you treat things at the federal level, you're going to treat it the same way at the state level. So it doesn't matter whether you're in Michigan, Illinois, Wisconsin, that's all going to be the same. Okay. In terms of the nonprofit, that's going to be a very specific case. So if whoever asked that question wants to email me afterwards, I would need to know more information about what the nonprofit is that you're working for and kind of what their policies are. Oftentimes it depends on how exactly that nonprofit is structured and if they're structured appropriately to actually give you some of these benefits. Okay. So this last slide was just showing how to calculate. This is how we figure out what is subject to income taxes. Okay. Second one here is how do we figure out what's subject to self-employment tax then? Okay. So this one, this is not actually given to you anywhere on the W-2. So your starting point is the first box on the W-2, box 1. But we need to calculate this ourselves on the tax return. So you're starting with your gross wage once again. You're going to subtract off all pre-tax deductions, just like you did with calculating income tax. Main difference here is that you are not subtracting the housing allowance from this. When we think about the housing allowance, whatever that amount that's designated, and I'll go over it a little bit more, that amount is going to reduce your federal income tax, is not going to reduce your self-employment tax. Okay, so you save federal and state, whatever state you're in, save that tax on it. You do not save the Social Security and Medicare tax though. And then on the yellow line here too, this is in the case where you have a parsonage. Parsonage is a little bit different, where you actually have to come up with what is the fair rental value of that parsonage. In that case, you actually add it back to your income. That's something of value that you received from the church. So you have to pay Social Security and Medicare tax on the value of the parsonage, plus utilities for the parsonage as well. Okay, so now we're going to jump into parsonage allowance a little bit. So when you live in a parsonage, you have to think about it as it is a form of compensation. Whether or not the church pays you $12,000 or they give you a house that is worth $1,000 a month, they've given you $12,000 of value. So when we're talking about a parsonage, when we determine that the fair rental value of it, and I'm just going to say it's $12,000 for easy math, you do not have to pay federal or state income taxes on this, but you do have to pay Social Security and Medicare tax on it. Okay, and that is second bullet point here is saying Wisconsin allows this deduction as well. That's every state. I should just say, typically I just work with individuals in Wisconsin, but every state is also going to allow that deduction. Housing allowance is a little bit separate in the way that you get this benefit. Instead of a parsonage, you're going to receive the housing allowance. In this case, you're going to designate a certain portion of your wages as being housing. Okay, so if you were paid $50,000, you're going to say, okay, I want to designate $20,000 of the 50 to be specifically for housing expenses. Okay. Whatever that amount is that you designate is going to be exempt from federal income taxes. What can this include? It can include purchasing a home. It can include renting a home. It could be either one of those. It's going to be not only the purchase price, it's also going to be furnishing the home and all the maintenance and upkeep along the way. These are kind of a little bit more of an extensive list of what qualifies as a housing expense. Housing expense, that's down payment on your house. That's going to be mortgage payments, homeowners association dues, could be homeowners insurance. Yeah, Jason.
Question, what category do retirees fall into? Self-employed or unemployed? And how does housing allowance apply to the retired?
For retired, you'll have to wait around all afternoon because second half of this afternoon, we're going to go over specifically for retired individuals. So, but the quick answer to that is retired individuals do not pay self-employment tax most of the time. So, other examples of what's included in the housing allowance, it's going to be utilities, furnishings. So think about if you're purchasing a new couch, a new bed, you're purchasing artwork for in the house. Anything that would be inside of your home is going to classify as a housing allowance. That also includes maintenance around the house too. You want to keep your house looking nice as well. Okay, so that's going to be you can deduct gas that goes in the lawnmower. You need to mow the lawn. Okay, kind of one of the really unique rules that the IRS has, which I don't really understand, is that it does not include a cleaning service, but it does include cleaning supplies. So if you're buying cleaning supplies for keeping your own house clean, that counts as a housing expense. But if you were to hire someone else, then it does not qualify for housing. So I guess the quick tip there is to tell you, if you were to hire someone, make sure you buy the supplies and have them use your supplies because you can deduct the supplies. Yep, Jason.
All right, two questions. One, understand housing includes maintenance supplies. Would it include the cost of hiring someone to maintain the lawn or snow removal?
Yes.
So you can have.
Oh yeah. The question was whether or not maintenance supplies and yard maintenance, that kind of stuff, if it's going to include the cost of hiring someone to mow the lawn or do snow removal, and the answer is yes in that case. Yep. Oh, we got one more. Jason, go ahead.
Question. Can the W-2 for clergy/employees, box 14, indicate amounts for non-elected employer contributions to 403B plans, crisp and unpicked?
The answer or the question was, can you use box 14 on the W-2 to indicate contributions into the UMPIP savings account? The answer to that is no, because those should be going into box 12, and there are specific codes for it. Jean?
So CRISP is supposed to be church contributions, not personal contributions.
Okay, so, and that's one part that I was not even familiar with. So CRISP, I am not familiar with, but Jean was just letting me know that that is the church contributions. So those should not be going on the W-2 anywhere. The CRISP contributions are made by the church. The W-2 is more a reporting of what the employee themselves did and the contributions that they made.
Another one. If the church provides a parsonage, can you still use a housing allowance benefit?
Question is, if the church provides parsonage, can you still use the housing allowance benefit? The answer to that is yes, it's just titled something different. So if you have a parsonage The housing allowance in that case is going to be a furnishings allowance. So any expense that you have that you put into the parsonage is going to qualify as a housing expense. You still need to go through the process of designating a certain portion of your salary as a furnishings allowance. But in that case, it would be, yeah, if you're buying a couch, if you're buying stuff for around the house, all of that's going to qualify. The big piece is your allowance is not going to be nearly as large because you aren't going to have mortgage payments, real estate taxes, utilities, all of that stuff is typically paid by the church for a parsonage. So we got a question back here.
Regarding to furnishing allowance.
Yep.
If you buy something, it's personal use, like couch is your personal use, but still you will be exempted from tax. If that is the case, how about your car? If you spend for a car, it will be a tax exempt.
So the question was, if you're using something, if you're purchasing something like a couch for personal use, and that's included in the house, can you also go as far as deducting something like a car that's also for personal use? And the answer to that is no, you cannot deduct something like a car because that has nothing to do with housing. The exclusion is specifically for housing related expenses. So in that case, it's just going to be things that are related to your house. The car is not related to the house at all. Jason?
Question from Cheryl, what box on the W-2 does the furnishing allowance go on?
The furnishing allowance. So the question was in what box does the furnishing allowance go on the W-2? And that would go into box 14. It will still get subtracted from box 1. You start with your gross wage, and if you designate a certain amount as furnishing, you subtract it out of box 1 and just designate that amount in box 1 and say furnishings, $5,000 or whatever amount you decided to elect for furnishings. It is everything in box 14. You can think about box 14 kind of as a catch-all because nothing in box 14 is actually required, but it can all be very helpful to the accountant or to the pastor, whoever is preparing that tax return, whether it's you as an individual or you're having an accountant do it. Personally, I'm preparing taxes for individuals, and if nothing is indicated on box 14, I have no idea if they designated anything for housing. It's not indicated anywhere else, but it's really important information for me to have. So I always ask follow-up questions. I can't promise you that every accountant is going to ask follow-up questions based on what the W-2 says. So, yep.
You come. This is from Diana. If you calculate that your housing expenses were more than what the church designated, can you claim more?
We will get into that one. So that one is a question on what if you, trying to think which way it went, but what if you did not designate enough, essentially, and you spent more in housing than what you actually designated? Can you still claim that?
Well, and part of, I think, is tied into that question is sometimes churches say, this is your salary, this is your housing allowance. Can you designate more than what the church said
Yes.
on their line item budget?
Yeah. So in many churches, this might be any of your circumstance where the church will designate your salary in two different pieces, where they say, we are paying you a $30,000 salary and we are paying you a $20,000 housing allowance. So the question is, can you then designate additional housing so you aren't just limited to the $20,000 housing that was given to you? And the answer is yes, as long as the church will allow that. There's nothing, and you're completely allowed to do that according to the IRS. So it's just a matter of if the church is going to work with you on that, you designate an additional amount, might be labeled as housing, might be labeled as furnishings. It doesn't really matter. It's just going to be designated out of the $30,000 salary. Gene?
They have to have a resolution before the money's spent, and then there's also a follow-up to the, we have pastors who live in their own home versus a parsonage. And they may only use the parsonage rarely,
Okay,
if at all. So their own home is their primary residence, and then they want to designate a significant portion of their salary as housing allowance. And that is legal, as long as they have the appropriate resolution. I think that
correct. So Gene was bringing up a point of a situation where a pastor may be given a parsonage and but they don't really use it that much. It's not their primary residence. They also have a separate house, which is their primary residence. Across all of these rules, the IRS always states that you can only have one primary residence. So if you are living in that parsonage and it's not your primary residence, you are not going to be able to deduct furnishings for that parsonage. But you can certainly designate, if the church is going to allow it, you can designate housing to cover your other house that you own. So there's nothing wrong with that. I think where the water gets a little muddy is that we just have to determine there is only one primary residence and you can only claim expenses for one house. So, okay, we're gonna keep moving a little bit. I think we'll continue to answer questions as we go through this as well. So some of these questions might actually get answered by this slide. So a really common question is, okay, how much can the housing allowance be? Can I just designate my entire salary as a housing allowance? And typically, no, typically you can't. There are circumstances where we do, but the big piece here is the IRS has put into place other limitations to limit you from just saying my entire salary is housing and I don't want to pay tax on anything. Okay. In this case, on the right-hand column, the housing allowance is going to be the lowest of three different figures. So first one is the amount designated by the church. Okay, so this has to be done through a resolution at the beginning of the year. You cannot do this retroactively. It needs to be done at the beginning of the year. So it's really important to get all of those figures in and work with the church accordingly. The amount designated by the church, I always encourage you to make that number high. You have all the control in the world over that number. It may not be the limiting factor.
So is the
Yeah.
pastor designates, or is it like the treasurer that designates the amount?
Yeah.
An allowance?
So the question was, is it the pastor who's designating the housing, or is it the treasurer? Is it the church? Who's designating it? And ultimately, it's going to be the church, depending on their process. They might give you a number of saying, hey, your housing allowance is 20,000. The pastor can always ask for a larger housing allowance. Gene?
pastor determines what they need according to these guidelines. And it's not, the church designates what your compensation is gonna be.
Mhm.
It's not additional compensation, but then they bring a resolution through staff parish to the church or church conference or the church council. And then the church approves that resolution. Now, you know, and it's up to the pastor, along with their tax consultant, to justify to the IRS. So the treasurer's not on the hook for this.
Yep. So just additional clarification is that ultimately the pastor is designating how much they think is appropriate for their housing allowance. It's not additional compensation to you. It's just saying, of my total compensation package that's being given to me, I want to carve out this much, $30,000, $20,000, whatever number you think is appropriate. The pastor is going to designate that, tell the church, and then it has to go through the resolution and needs to be signed off on by the appropriate people at the church. The second number is going to be the amount you actually spent on housing. Okay, so it's really important to know that, because you can't just go designate $50,000 of a housing allowance. And then what if you don't actually have any housing expenses? What if you live with a relative? What if where you don't have any expense, you don't get the tax benefit unless you actually spent the money. So you need to keep good receipts throughout the year, keep good records as far as what are we spending on housing throughout the year, because that's going to be one of the factors that comes into play. And the third one is going to be the fair rental value of the house. You need to come up with a determination of what is the fair rental value. Okay. Yes, the pastor, the taxpayer, is responsible for coming up with the fair rental value of the house. So, and I'm going to go over that on this next slide here. So how do you determine the fair rental value? Determining the fair rental value, the IRS doesn't give us any specific way saying, hey, this is how you determine it. Okay, so it's kind of left up to the pastor to make a good faith effort. Our personal preference, best way to do it is to have a licensed, real estate agent actually write a letter saying, hey, this is the fair rental value based on comparable properties in the area. That's going to be the most solid form of proof if the IRS were to question you on it. IRS questions you on it and you provide them a letter from a realtor in your area, the IRS is going to accept that. Okay. Another method, which is what ultimately a lot of people end up using, is they just personally go out and find what are comparable properties in the area. Hop onto Zillow, hop onto realtor.com, try and find, listings for rented properties that are similar properties to your own, and basically make a best guess possible there.
Excuse me. Right.
Yeah.
Sorry.
Yeah.
But this is if we own the house, right?
Correct.
Or not rent the house.
Even if you were to rent it. Yep.
So
If you owned it or rented the house.
if we rent, does the value of the rent?
It-
Pay for rent?
Yeah. So and really good question. So oftentimes when we think about housing allowance, we kind of just make the assumption that it is for home ownership. Doesn't have to be. It can be a rental situation as well. So if you are renting a house, you still need to come up with the fair rental value. The difference is you want the fair rental value of a house that is fully furnished with utilities included. So that's kind of the tough part, is how many places are available for rent that are fully furnished with utilities included. It's hard to find comparisons there. So typically, I think it's very reasonable to take a look at a house. If it were to be furnished, it's going to be at least an extra $1,000 a month. If that's so, I kind of just inflate whatever that number is going to be, make the best guess that you can. Oftentimes, though, that's why we say, hey, that's why you should have a realtor come in. A realtor will be able to tell you what a fully furnished place is going to rent for. Yep.
We have a special circumstance. We have a part-time pastor whose primary residence is not the parsonage, but who is living in the parsonage because they're building a house. So I guess my question is, what number do we take? I know you said primary residence is, the one you would, that for the tax purposes. But the church is paying the parsonage's utilities. So I don't know. Maybe we can talk later.
We're going to talk about that one later. Yeah. Yep. So some of these questions too that's a lot of the questions. If you have specific questions, certainly if you're in the room, we'll talk afterwards. If you have really specific questions for your situation and you're online, you're going to get our contact info at the end too. So certainly shoot us an email. We can kind of help you sift through your specific situation. Okay, here's some actual examples. I find examples are really helpful for me to actually help work through, because so far I've just kind of dumped a whole bunch of information on you, and now I actually want to try and give you some real examples here. So in this case, we've got Pastor Ann. She owns her home and designates $20,000 of her salary as a housing allowance. She spent $21,000 on mortgage payments, taxes, utilities, and other furnishings. She determined that the fair rental value of the home is $24,000. So in this case, we have to take the lowest of these three numbers, the amount designated, the amount spent, and the amount the fair rental value amount. And so in her case, she can exclude $20,000 from her income. That's the lowest of those. So put this example together for a reason. This is very, very common what I see. This should never happen. Okay, if this happened, then we made a mistake on our end. We should have designated more. The pastor designated 20,000. That should not be the limiting factor. That's the one thing that you have complete control over. So if I was working with this client, I would have the church designate 24,000 the following year, because that's what the fair rental value is. I typically try to match whatever you determine the fair rental value to be with, that's the amount I want to designate. So we come up with that amount and we say, hey, 24, because even if you designated 30, you could say, hey, we want to designate 30,000 just to make sure that it's not the limiting factor. Well, we know that the fair rental value is 24. You're still going to be limited because you're taking the lowest number. Okay. So, and even in this case, you switch it to 24,000 the next year, we're still actually going to be limited to 21,000, assuming that Pastor Ann paid, had the same amount of expenses. You're still taking the lowest of those numbers, but hey, at least we didn't limit ourselves based on the amount designated. Here's an example with a housing allowance, kind of calculating the two different columns. Here's the amount we need for income tax. Here's the amount we need for self-employment tax. Okay. So all the variables are at the top. We're talking about a $50,000 salary. Housing allowance designated out of that 50,000 is 20,000. Okay. So that's not additional compensation. Compensation is not 70 in this case. It's 50. 50 is the total. So 20,000 housing allowance that's designated. In this situation, they've elected to do UMPIP contributions of 3,500. They have a medical flex plan of 1,200. Professional expenses in excess of what was given to them by the church. So anything that's reimbursed by the church, you don't get deductions for that at all. Okay, it's only what's above and beyond. And then this pastor has a HSA option for health insurance available to them as well, and they put $2,000 into that. So on the right hand side, let's look at that one first. Calculating federal taxable wage. We're trying to figure out what is box 1 of the W-2. Starting with 50,000, we subtract off the housing allowance, 20,000. We subtract off UMPIP contributions. Now we are making the assumption these are pre-tax contributions. Okay, so if these contributions were elected to be Roth contributions, you're not subtracting that off of this line. These are pre-tax UMPIP contributions. We also subtract off the medical flex plan. And then you're subtracting off the HSA contributions. Notice in there, we are not subtracting off professional expenses. Since 2018, we are no longer allowed to deduct professional expenses for income tax purposes. Okay, and that's what we're talking right now is income taxes. So total that would be in box 1 is going to be 23,300. Go through the same exact exercise with slightly different rules for self-employment tax. And you're going to start with your $50,000 salary. So over on the left column is where we're looking right now. You're going to subtract off 3,500 for the UMPIP contributions, 1,200 for the flex plan, 2,300 for professional expenses, 2,000 for the HSA. Okay, so you're not deducting that housing allowance that was designated for you. So keep that in mind. The professional expenses are deductible here though. So this is where it's really kind of zooming out, and what happened in 2018, we had the Tax Cut and Jobs Act, which totally flipped our tax code upside down. And they eliminated professional expenses from being deductible as an employee. So I work at Menninga Tax and Financial. I cannot deduct anything. Say I were to set up a home office and I were to spend $5,000 on a desk, a chair, computer, paper, printer, all that stuff at home. I can't deduct anything because I'm an employee of Menninga. If I had my own business and I were self-employed, and I set up the same exact office in my house, I can deduct that. All of that is deductible. So once again, clergy are wearing two hats. They're in some cases self-employed, in some cases employees. So for calculating self-employment tax, unreimbursed expenses are deductible. You take that off of your income. So I've ran into a lot of pastors who thought that they could no longer deduct professional expenses, and it's half true, essentially. So it's keep those records. You need them throughout the year, and they can still be of benefit. Here's the example of the W-2 then. And it's pretty small print for anybody in the room. I don't know what it looks like online, but up in box 1, we've got 23,300. So that's box 1. This pastor did not elect any federal withholding, which is box 2. There's nothing there. There should never, ever be anything in boxes 3 through 8. These boxes should never have any figures in them. So that's kind of a little note to any treasurers who are putting together W-2s who might be on. In this case, for pastors, there should never be anything. So if you're working on your pastor's W-2 and there is something in box 3 through 8, you need to back up. You did something wrong. So Jean?
Unless your pastor is not yet credentialed.
Okay, good point. So Jean brought up, unless your pastor is not yet credentialed. Okay, so I am talking about pastors who are eligible for the housing allowance, who have been fully licensed and are treated as pastors. Okay, if they are not yet credentialed, then they will be treated like any other normal employee of the church. In box 12, kind of this goes back to a question we had earlier about where do we put the contributions to the UMPIP? Do we put that in box 14? No, we don't want it in 14. We want it with a code E, 3,500. That is the UMPIP contributions. Okay. If it were a Roth, you're making Roth contributions, there's a different code. It still goes in box 12. And the code is B. It's 2 B's. We have instructions for preparing W-2, and a Roth example is provided in there as well. I'm going to give all of you in the room a copy of that today, and then everybody online is going to get a copy of that electronically as well. So that's going to be in the event that you did Roth contributions as well. Code W for the HSA. And then box 14, like I kind of mentioned before too, nothing is required to be put in that box, but it is very, very, very helpful. So please do put the housing allowance in box 14, put the flex spending account in there. Let us know. If you don't leave anything in there, I have no way of knowing whether box 1 is correct or not. That helps me kind of back into some of these numbers to say, was the W-2 prepared correct at all? Did you have a question, Jason? Yep. Yep.
So if I buy a new computer to use in my home office that is used only for church, I can deduct that?
So the question is, if I buy a new computer for in my house that is used only for church purposes, can I deduct that? So going back in this scenario, so this is our income tax column. So the answer there is no, you cannot deduct that computer for income tax purposes. So you do not receive a deduction for federal or state income taxes. You do receive a deduction for it for self-employment tax. So keep in mind our tax code, there are multiple different kinds of tax. Okay, so income tax is a graduated tax bracket, which the lowest tax bracket is 10%, and it goes all the way up to 36% tax. Okay, so I don't know what tax bracket you're in, so I can't tell you what the tax savings would be for your specific situation. State income taxes in Wisconsin range between 3.5% to 5.5%, roughly. Okay, Self-employment tax is a fixed amount. It is 15.3%. It doesn't matter if your income is 50,000 or $1 million. It's 15.3%. That's what the self-employment tax is. So to answer the question of deducting the computer, you deduct it against self-employment tax. So you're going to save the 15.3% tax on it. Yep, Jason?
Another question. For pastors that are not credentialed, do we complete a W-2 or a 1099?
For pastors that are not credentialed, do you complete a W-2 or a 1099? You should still be getting a W-2 unless you have a very strange agreement with the church. You should just be W-2 employee, and the church should be paying half of your Social Security and Medicare tax in that situation as well. So if you're not credentialed, none of this applies to you that we're talking about today. So hopefully you plan on being credentialed if we're learning this. So, but yeah, for anybody who's not credentialed, this stuff does not apply to you or your tax return. Yep.
Are we pastors considered self-employed?
So pastors are considered self-employed for self-employment tax purposes. Okay. Yep. But they're considered employees for many other reasons, and for federal and state income taxes, they're considered to be employees.
And self-employed, we cannot deduct the housing allowance?
Correct. So, yep, and that we can say it as many times as we want because it's good to hear it. So the housing allowance, at the end of the day, you're saving federal and state income taxes on it. You do not get to deduct it against your self-employment tax. So you don't, that's where we see bottom line here. This is the number. You'd be paying self-employment tax on $41,000 on the left column here. You're going to be paying federal and state income tax on $23,000. Okay, so typically pastors are going to pay significantly lower federal and state income taxes than most other occupations, and they will be paying significantly higher self-employment tax than most other occupations. So typically it actually balances out to where those two, it's not totally depends on your circumstance, but some cases I do see where pastors pay more tax than they would if they were just a standard employee. Sometimes I see where they're paying lower. Sometimes it's very close. More often than not, it is a benefit. It is more beneficial to have all of these complexities. Okay, it's a pretty rare circumstance that a pastor pays more in tax overall. Okay, same exact thing we're going to go over here, except this is for a parsonage. So for anybody who has a parsonage, treat it a little bit differently. We're still starting with a salary of $50,000. The furnishing allowance is going to be designated as $4,000. Oftentimes, the furnishing allowance, you can call it a housing allowance too, but it's more specifically for furnishings because you're paying for furnishing the house, not really paying for like the mortgage and all of that. So that's where we have a much lower amount typically for the furnishings. Fair rental value in this case we've determined is $20,000. Utilities paid for by the church. The church paid $3,000 of utilities throughout the year. UMPIP contributions are the same, $3,500. Flex plan for medical flex plan is $1,200. Professional expenses are the same. Tried to keep all of this stuff really consistent, just trying to show the difference between housing and parsonage. So for calculating federal taxable wages, same exact scenario here as the last one where we're subtracting off furnishings. That's kind of the housing allowance. In this case, you're subtracting off UMPIP contributions, medical flex, and HSA. We have a much higher bottom line here of $39,000. That's a $16,000 difference because if we think about it, we're only subtracting $4,000 off. That's the furnishing allowance. We're not subtracting a whole $20,000 off of this. For a self-employment calculation, you're going to see this is quite a bit higher because you're not designating a housing allowance in this case. What you're actually doing is you are required to add to your wages, basically, the fair rental value of the parsonage. Church is giving you something of value. So if you were comparing these two salary packages too, you would say that this one is worth a lot more because you received a house in this case. Someone's paying for all of your living expenses for that house. So adding 20,000 in, and this is a number, it's fair rental value. So this is, the IRS doesn't know this number. Nobody knows that number. That's up to the taxpayer to pick an appropriate number. Come up with the fair rental value as best as you can. This is a very, very good example of where our entire tax code is built on the honor system. Okay, so it's up to us to be diligent in that and put forth our best effort on coming up with an accurate number. We're also going to be adding utilities in this case too, because that was another, so $3,000 of utilities were paid. We have to add that back as well. That was another benefit that the church gave you. And then we're subtracting off UMPIP account, medical flex. Once again, on this side, that $2,300 MacBook Pro, you get to deduct for self-employment tax purposes. And then $2,000 for the HSA. So what does it look like here? It's going to look, this is the W-2 example. Box 1 is the 39,000. The big thing that I want to point out here is your furnishing is listed here. So furnishings of $4,000. Nowhere on here is listed the fair rental value of the parsonage. I have seen some churches actually put the fair rental value because the church decided to come up with a value. The church owns the property. It's not often that I see that. I have seen it, and I always want to verify that number if that's the case. But it's just to point out, you guys, especially as a part of the United Methodist Church, that is not the case. I've typically seen it with other denominations, but you're not going to be given that number. So just know if you're in a parsonage, there's a variable throughout this whole scenario. The church is going to give you your tax documents. There's a number you have to go somewhere else and get to complete your tax return. And that's the fair rental value. One other reminder in this is all W-2s, whether it is a parsonage or a housing allowance. And I come across this really, really often. Box 1 and box 16, which we haven't talked about at all. Box 16, you can't really read that down there, but it just says state wages. So what's taxable for the state. Those two should always be the same. There's not a single example anywhere where those two should be different for a pastor. Jean?
Sometimes I suggest to people to figure out the fair rental value of the parsonage to multiply their salary times 25%. So that's a formula that we use for calculating pension. So it's something consistent that could be done, and it would help it helps to address some of the differences in different areas of the state and where people are on minimum compensation, especially versus higher compensation. Does that,
Yes.
hearing people wrong?
So Jean has an example of where oftentimes they may give recommendations in determining the fair rental value of the parsonage, that we just simply, let's take 25% of whatever your salary is. Typically, I'm just thinking this through, typically your salary will be higher in higher cost of living areas. So if you're in Dane County, you're going to have a higher salary. The parsonage is going to be worth more in Dane County than it is in Rice Lake. So I will not say that I agree with or support that way of doing it, but it's a way that you're going, once again, with the best way that you can go for. I've seen people do that as well. That's not the first time I've heard it, Gene. So I've seen that where many individuals just say, yep, 25% of the salary. I just think there's too many variables to give that as a blanket statement, because you could have the parsonage could be 4 bedrooms, it could be 1 bedroom, it could be very different in every, that's the hard part of where I have a hard time giving that blanket statement across the board. Yep.
Usually furnishing will be done by the pastor, but the utilities will be taken care of by the church.
Yep.
So should we include both the items in the same?
Yeah, so the question was that typically pastors are going to be the ones who are responsible for furnishing the parsonage, but the church is responsible for the utilities. So in that scenario, you're going to see the utilities is actually a number that in a perfect world, the treasurer will include this on the W-2 for you. So the treasurer looks back at the church's records from this last year and they say, hey, we paid $3,000 of utilities. The utilities are a number that needs to be provided to you by the treasurer. The furnishings is no different than the housing allowance where it's a number that you designate once again. So both of them do get factored in here, but the utilities does need to be provided by the church. And oftentimes I would say more often than not, the church does not provide that. You should be going back to the church. And even if it's not, once again, box 14 is optional. So they aren't required to put that on there for you, but it's one of those pieces you just need to go back to the church and say, hey, what did you guys pay? And what's the number for utilities that you paid for us for the year? And they might just give you a quick summary sheet or something of what the utilities were. Okay. Weddings, funerals, and honorarium income. This gets a little bit away from the W-2 reporting because this is reported as just self-employment income. Okay, so this is actually very straightforward where this is as if you had any other business. You're just a true self-employed individual in this case. Okay, so if you receive $1,500 throughout the year for income for weddings, funerals, other speaking engagements, then you need to report that $1,500 on a Schedule C on your tax return. Any expenses that are directly associated. So you do a wedding, you drive 200 miles to get there. You hop on a plane, you have a plane ticket, you have lodging, you have whatever it is, any expenses that you have, you do have to, you're able to deduct. Most common one would be wedding gifts. Do you get to deduct that as well? You do. The IRS limits you to $25. So it's a really random IRS law that there is. So $25 is the maximum that you can deduct. So you give them a $100 gift, you deduct 25 of that. Your income is going to, after your expenses, so say you had $1,500 of income, $500 of expenses, you'll have $1,000 profit from weddings and funerals. So that's all going to flow to a form, which is a Schedule SE for self-employment. And all of that gets grouped together with, going back here, this number here. So actually what would be on Schedule SE for you guys in this example with the parsonage, you'd have $64,000 coming from your calculation based on your wages. You'd add $1,000 profit for my example for weddings and funerals. So you'd have $65,000 in that case. This is one I just like to touch on real briefly too, just letting you guys know that it is an option. Maybe some of the pitfalls with it as well. If you are a new pastor, this election is available in the first 2 years of being a pastor. You don't have the option after that. You can claim an exemption from Social Security and Medicare tax, the self-employment tax. Complete exemption from it. Never have to pay Social Security and Medicare tax on your income from the church. Again, if you were self-employed separately, you had a completely separate self-employed business, this doesn't exempt you from that. Okay, because the whole purpose of this is that you're claiming a religious exemption, and the direct wording is you are conscientiously opposed to public insurance because of your individual religious considerations, or you are opposed because of the principles of your religious denomination. So that's one condition. You also have to file for other than economic reasons. So what that means is you can't just file this to say it's cheaper, I don't want to pay the tax. Okay, has to be other than economic reasons. Okay, and then the form 4361 it has to be filed timely. That's the form that you would claim this exemption on. My caution to anybody who might think about doing this is, first of all, I don't think it would line up with what your denomination believes. So I'd consider that to begin with. The second aspect of it is Social Security and Medicare are very, very important pieces of your retirement plan that you may not be considering, and not even retirement. It's disability insurance as well. Something happens where you can no longer work and you're 45 years old. Social Security is there and provides a benefit for you at that point. So I have seen a few individuals who have opted out, and I hope they're saving enough elsewhere, because they will not have any benefit from Social Security when it comes time to retire as well. So a lot of cautions there. And honestly, I think the biggest caution isn't even retirement. It's the disability side of it as well. And also health insurance costs. You won't be eligible for Medicare at age 65, that's the health insurance that you're going to be using at that point. So very, very risky decision to do this exemption. Okay, this is separate from kind of clergy related tax matters. So feel free, if you do have more questions that come up, just send them over to Jason. Anyone in the room, we can talk afterwards too. This is more just some tax tips that are really good for you to know regarding your congregation as well. So qualified charitable distribution is a specific way in which you can donate money to a nonprofit. Okay, it does not need to be a church, it can be any. So it's just good to know in general. But qualified charitable distribution, what it is a direct transfer of funds from your IRA custodian, and it is payable directly to a qualified charity or church. It's counted towards satisfying your required minimum distribution, and it is not included as taxable income on your tax return if certain conditions are met. So a lot of stuff going on there, because a lot of stuff doesn't apply to maybe 3/4 of the people who are listening today. So first, I want to talk about what a required minimum distribution is. If you are saving in your UMPIP account or a traditional IRA, or you have a 401k, your spouse has a 401k at a different place of employment, any of those accounts at age 72 currently, you are required to start taking money out of those accounts. The whole reason for is, what's that? It's 72. Not 70 and a half. So the old rules for required minimum distributions, it used to be that you had to start taking distributions in the year that you turned 70 and a half. The IRS changed that to 72. They did not change a qualified charitable distribution to match that though. So qualified charitable distribution is now going to confuse us because it is still 70 and a half. And the required minimum distribution is 72. And they are still in the process of trying to think if they actually passed it or not. I can't remember, but I think it's very likely that it will pass if it is not already. Required minimum distributions are going to be moving to age 73. And then in the year 2033, they jump again to age 75. So required minimum distribution ages are bouncing all over the place right now. So that's not too relevant though. The whole point of a required minimum distribution, the IRS says you put money into this UMPIP account, the pre-tax version of it. You received a tax deduction. You have not paid a tax on any of this. We want you to start paying tax. So they require you to start taking money out. The first year, they require 3.6% of the account. So if you have $100,000 in this account, they're going to require you to take $3,600. And each year, that amount, that percentage kind of gets larger and larger. So what happens in the case where you say, I don't want to take money out of my IRA, the UMPIP. I don't need it, you know. That's where it could be very beneficial to do a qualified charitable distribution and just have Westpath send that money directly to the church or to any other charity of your choosing. Now, one piece I do have to clarify on this is only eligible for IRAs. So it is not actually eligible through Westpath. Okay, so this might be some additional planning where you're looking at, okay, UMPIP, I want to keep that money there because I like Westpath, because it's eligible for the housing, and you need to keep the account at Westpath. You need to keep that account there for it to be eligible for housing in retirement. That's kind of this afternoon's segment a little bit too. But the important part there is, if you have a spouse who has a 401k, they can't do a qualified charitable distribution out of their 401k. You'd want to roll that 401k into an IRA, and now you can do qualified charitable distributions out of an IRA. Okay, so the important part is you need to get this money into an IRA before you're eligible for this planning. So it has to be directly sent to the charity. Maximum amount is $100,000 annually. And it has to happen before December 31st for it to be eligible for that year. Okay, so you can't do anything like retroactively. It has to happen in the calendar year. Yep.
All right, circling back to W-2s.
Yeah.
Two questions. First, from Bill, pastor pays his clergy pastor insurance. Is that taken off wages on W-2?
Bill the pastor?
So the I don't know if Bill's a pastor or a treasurer, but if a pastor pays their personal portion of the health insurance, is that taken off of wages on a W-2?
Okay, so the question is, just circling back to W-2s real quick. If the pastor pays a portion of the health insurance, do you deduct that off of the income reported on the W-2? And the answer is yes. So anything paid by the pastor is deducted off of their income, not what is paid on their behalf by the church, though. It's what is paid by the pastor gets deducted.
All right, next question, longer. The example shown for parsonage in calculating taxable wages for box 1 on the W-2, the example did not deduct the fair market rental value, only subtracted furnishing allowance. Based on my quick reading of tax topic 417, publication 517, one can exclude that amount from gross income. Did I miss something?
The question is, in the example for the parsonage, for the federal taxable wages over here, we're only subtracting off the furnishings. But based on this individual's reading, the IRS publications state that you are able to exclude the fair rental value of the parsonage from this calculation as well. So why are we not subtracting off the fair rental value of the parsonage in this case? That's the question. And the answer is, it was never in here to begin with. So the fair rental value, that's above and beyond. If you want to subtract it, you can. You have to add it in first, though. So we have to start with 70. Okay, so that's the difference there, is the fair rental value is, that's, if the fair rental value were part of the total salary here, which it is not, you know, then it just depends on how you do the math there. But no, you can't take the fair rental value off because that's additional. So we're not including it here because we're not adding it in. If you take a look on the self-employment side, we actually add the 20,000 in. That's where we're excluding it over here. So hopefully that makes sense. So have to add it in for self-employment tax, but you exclude it from the income tax side by not adding it in. Okay, so qualified charitable distributions, just to give you kind of some real numbers as far as how impactful this can be. Do you have another one, Jason?
Yes. Just popped up.
Yeah.
So could you have the furnishing allowance at 20,000 instead of 4,000?
You could have the furnishing allowance at 20,000 instead of 4,000. Going back to this example, yes, you could. if you're spending $20,000 a year on furnishings, you might be. It just depends on your circumstance. More typical for what we see is more in the I do see it get up to $10,000, $4,000 to $10,000. Anybody knows it does not take much to spend $10,000 when you buy a sleep number. That is, you can get there pretty quick. So in this example, I wanted to make it significantly lower just for the purpose of showing. I didn't want those numbers to get confused. So yes, the 4,000 in furnishings can be bumped up higher. So there's no limit on it, really. You're going to have the same limitations. So you're going to be limited to how much you actually spent and what was designated. So
Have receipts for the expenses, right? You should have the receipts to show.
yes, you're going to need the receipts to show. So you cannot simply designate 20 and just deduct it. You do have to actually have 20,000 in expenses and keep your receipts, keep your records for that purpose. So there's a lot of planning that can go into this, because when you think about your budgeting, say you were in this situation where you designated $4,000 and you say, yep, I think I'm due for a new bed. Would you want to buy that December 25th? Probably not. You'd probably want to wait until January after you've redesignated your furnishing allowance to be 15,000 for the next year, or whatever the appropriate number is. If you were to buy something really expensive in December and you only designated 4,000, you're going to be missing out. You're just out of luck. So there is making sure that your spending matches your designation, and getting those years lined up is really important. Okay, example for qualified charitable distribution. Imagine you donated $6,000. So not what this slide is saying, but just imagine you donated $6,000. You wrote a check to the church. Okay. Under our current tax system, you either get to itemize your tax deductions or take the standard deduction, whichever is higher. And currently, the standard deduction is upwards of $26,000. They just give you a blanket $26,000. And unless your itemized deductions are higher than that $26,000, you don't get any benefit for charitable donations, for real estate taxes that you pay, for your normal itemized items that you would deduct. So you write a check for $6,000. 9 out of 10 people will not receive any tax benefit for doing that if you just write a check to the church. If you have $6,000 go directly to the charitable organization, though, you do get a benefit for that, regardless of whether you're itemizing your deductions or taking the standard deduction. Okay, and I'll show that on the next slide here. But basically, in this scenario that we put together, you are going to see tax savings of 25%, which is equivalent to almost $2,500 on this deduction. So, okay, so it's a really blown up version. I wanted to make it really blown up so everybody could see it. But this is a married filing joint couple. Their IRA deductions or IRA distributions are $55,000 up here. Okay, on line 4B. And in this scenario, this is as if they were to just write a check directly to the church. Line 8 is their standard deduction of $27,000. So they get the standard. They didn't get to deduct the $6,000 anywhere because it's part of the $27,000 that they get regardless. So the next example is just showing $55,000 on 4A right in the middle. That's still the total IRA distribution. 4B is $49,000. That's where the deduction happens for contributing to directly from your IRA to the church. So now you only report $49,000 of income. You still get a standard deduction. That's still exactly the same. The bottom line, this number total tax that I'm looking at is $7,400 in this example versus $9,900 in the example before. Another reason why that number is so drastic, so large there, is this is the first example. I want you to take a look at Social Security benefits. Social security benefits for this couple is $58,000. It's a married couple, so that's 2 individuals' social security benefits. The way that social security is taxed in retirement, you're going to pay tax on up to 85% of the benefit. Okay, that's the maximum. So you're never going to pay tax on all of your social security. In this case, I'm pretty sure that is 85% is $48,500. It's based on all of your other income though. So if you're an individual whose social security is your only source of income in retirement, you don't pay any tax on social security. Okay, so it's kind of means based. And if that's your only source, they're going to say you don't need to pay tax on it. If you're fortunate to have a pension or to have an IRA where you can take $55,000 out though, you can afford to pay a little bit of tax. Okay, that's the rationale behind it. So if we take a look, $48,500 is taxable for your social security. We go to the next scenario. When you did that qualified charitable distribution, you're only reporting $49,000 as taxable now. $43,400 is taxable for social security. So we just created a domino effect where you not only got to subtract $6,000 off of your income for what you gave to the charity, you also reduced how much of your social security is taxable. That's why we have such a large difference where you save $2,500. You know what that means? As pastors, you should kind of be thinking, I wish my congregation knew about this, because if they didn't need this money anyways, and they were trying to give the maximum that they could have given you an extra $2,500. That's their tax savings. It's much more efficient for them to give it to you directly out of the IRA, give you an extra $2,500 versus them just writing a check and giving the government an extra $2,500. Okay, so giving efficiently is really important for you to know as leaders of the church, because you can help just encouraging, I think, congregation members to make sure that they're giving in the most efficient way. So once again, this applies to individuals who are 70 and a half or older. So no need to go let all of your community groups who are like young married couples and everything know about qualified charitable distributions or anything like that. But it's for retirees is really what we're looking at. I'm going to skip over that one today. I think where are we on time, Jason?
10 minutes to the retiree portion.
Okay. Let's say that's good. There's definitions and stuff in the back, just kind of reminders of parsonage, housing allowance stuff. We will get a copy of the whole presentation to everybody in the room. You have a copy of it. Jason, I'll get you the electronic copy, and then you can share that with everybody. I think Jason's going to have this recorded. You can rewatch it to kind of refresh your memory on some things. And then any questions that you have, you'll get my contact info too. So if you have specific questions for your situation, feel free to shoot me an email. And yeah, that's all I got for this one. So good.
Thank you.
Yep.
So. Yeah, we have waiting. Well, we're gonna be on there. Oh, yeah.
So you will just include the seven.
Yeah. And if you have, yeah, if you have additional.
Thank you, I will. Thank you so
Did I go like a half hour over, Jason?
Not yet.
All right, everybody. I think we are ready to get going with a section on retirees. Can you pass these ones out? Okay, thanks.
Behind.
Okay. All right, we're just kind of clearing out in the room here a little bit and getting ready for this next section, but the next section is going to be there'll be some stuff repeated, but I'll skip over a lot of things because this is kind of designed for individuals who are in their year of retirement. So I will touch base on retirees in a full year, but this is also helpful for anyone who is kind of in their transition year. So, all right. So we're gonna jump past a whole bunch of this stuff. A lot of these are similar, but okay. So for retirees, here's the good news. This was one of the first questions in the last section too, is for retirees, do we have to pay self-employment tax? Forget the self-employment tax for the most part in small print. Okay. So good news is you don't have to pay tax on self-employment tax on like Social Security. If you're drawing Social Security, you don't pay self-employment tax on that. Okay. Or you turn your pension on and your pension from UMPIP, you don't have to pay self-employment tax on that. So for the most part, most of your income in retirement is going to be exempt from self-employment tax. The IRS, when we think about self-employment tax, we're thinking about earned income is subject to self-employment tax. Okay, so the IRS, they give you examples of what is earned income. That's going to be wages, salaries, tips, other taxable employee compensation, earned income from self-employment income. That would be weddings, funerals. We'll talk about those. If you're still performing weddings, funerals, and doing other speaking engagements, that is self-employment income. You still have to pay self-employment tax on that. Earned income is not going to include, it's specifically excluded, amounts such as pensions, annuities, welfare benefits, unemployment compensation, workers' comp, or Social Security benefits. Okay. Calculating income for estimated tax payments is probably one of the biggest questions we get for retirees, because retirees go from, if we're making the assumption that you paid estimated taxes while you were working, which you can do, you can also have the church just withhold taxes directly from your paycheck. Either way, the IRS doesn't care how they get paid, they just want to get paid. Okay, so this is just going to give you an example of how do we kind of project your tax return and figure out how much you should be paying in estimated payments. This is not designed to actually give anyone a specific answer because everybody's tax situation is different. Okay, but it's more of a reminder of, If you are drawing your pension, you have Social Security benefits, and there's no tax being taken out of those payments, be prepared to pay some tax at the end of the year, potentially. Okay. So if we just take a look at this tax form, in this situation, we've got a married couple who took $10,000, line 4B, they took $10,000 out of their IRA. Okay, they took $30,000 from their pension. I'm going to assume their pension is $30,000. $10,000 is taxable. You'll see line 5B. Reason why, we'll talk about this more a little bit later too, but $30,000 is the total pension. Only $10,000 is taxable because you are still eligible for a housing allowance. The way you calculate that is you just total up how much you spent on housing that year. And in this case, they spent $20,000. So $30,000 was the total pension. Subtract 20, you get $10,000 for taxable income from your pension. Okay. Social Security benefits are $35,000. And I touched briefly on it in the last segment, right at the end, was Social Security. We see, especially in this case, it's barely taxable. You're only paying tax on $2,750 of your Social Security because you're just getting to the point where the IRS says, hey, you can afford to pay a little bit of tax on Social Security. Okay. So in this scenario, we've got their total income all totaled up to $22,750, but their standard deduction is $27,000. Okay. So their deductions wipe out all of their income. Their taxable income is zero. And over here on the left-hand side, giving you the total federal income tax is zero. So it's possible that this is not that uncommon if you actually think about it too. If you take a look at this scenario, you have $10,000 from an IRA, $30,000 from the pension, and $35,000 from Social Security. Your total income was $75,000 in this case, and you paid zero tax. That is not that uncommon. So especially for pastors, because they still are eligible for the housing allowance in retirement, it's able to take some income off of your return you don't have to pay tax on. Give you a really similar example. It's just the difference. All I did was I increased the IRA contribution. So the very first line there, 4B, instead of $10,000 for an IRA distribution, we've got $20,000. And what does that do? It causes a little bit of a domino effect on Social Security. You're now having to pay tax on almost $9,000 of your Social Security benefits. You see how the more you take out of IRAs, the more income you have, the more you have to pay tax on Social Security. You're kind of in this phase-in range where the IRS says, hey, you're able to pay a little bit more. So in this case, we've got taxable income all the way at the bottom is only $11,000. Okay, so your total, it's about $1,100 of federal income tax in this case. If your total tax was going to wind up being about $1,100, would you pay estimated tax payments? You might. It's almost kind of personal preference at that point. Would you rather just write the IRS a check at the end of the year for $1,100? Or would you rather break that up and say, okay, every quarter I'm going to send them $300 and kind of budget that into your retirement income? One thing you want to watch out for there, the IRS will penalize you if you owe them more than $1,000 at the end of the year. So estimated payments are beneficial. If you think you're going to owe more than $1,000 in tax, you really should be doing estimated payments just to avoid any penalties and interest that they might charge you.
James, can I?
Yep.
And this is for me, so
Yeah.
I know as an active clergy, I need to declare what I'm doing for housing with the church conference. Who does the retired clergy declare to, or do they need to declare to anybody?
Yeah, so yep. So the question that Jason had was, how does a retiree designate their housing allowance? Well, you're working as a pastor, you know you have to talk to the church and you need to designate a certain amount as housing. How do you go about doing that since you're not tied to a specific church once you're in retirement? And I think that's on another slide coming up, but we'll talk about it now anyways. It's really easy. The conference, annual conference every year, they designate the entire amount of your pension, the entire UMPIP account. It's all designated as housing. 100%. They just do a blanket designation. Why do they do that? They don't want you to be limited. Why would you limit how much you can take as a deduction? We can designate the entire amount as housing. Now you still fall into the same limitations. You still have to track what you spend. You still have to know the fair rental value of your house. Those three items, then you take the lowest of those three to determine how much you actually get to subtract off of your income. So, but the conference is just going to do, make it really easy from a designation standpoint where 100% is designated for you, your entire retirement. Okay. So you really only have to come up with two numbers: amount you actually spent and fair rental value. One other example, same thing. All I did, once again, I just bumped up the IRA distribution to 50,000. So two previous examples were 10,000, 20,000 for an IRA distribution, and then 50,000. In this one, you really see a big jump. Now you have to pay tax on 30,000 of your Social Security. Really big increase there. Okay. But you think about it, is it easier to pay tax? Can you afford to pay tax on Social Security if your income in this scenario was a total, well, we got the 50, got 115,000 of income on this tax return, actually 115,000 that you actually took home. That was your take home. If you had 150,000 versus 75,000, you can understand kind of the IRS's rationale, whether or not you agree with it. We don't have to agree with the IRS, right? So, but we do have to follow the rules. So these, there are not like, this is just in our tax software. I just put together examples, just showing. There is a specific form for calculating how much of your Social Security is taxable. It's a pretty cumbersome form to calculate, but you could probably find some projections online just on like if you were to Google like an estimator of how much of my Social Security will be taxable, they'll let you put some variables in. I'm sure you can find that as well. Yep.
You move to some retirement community. Is the cost of living in a retirement community, is that all considered housing then?
If you were to move to a retirement kind of community where you're living there, are you able to count all of that as housing? Yes, you are. So the fair rental value is it's a little trickier in there where you almost have to, you almost really match what you actually are spending. And you say that is the fair rental value. If you're in a retirement community, you typically are not having a lot of extra stuff that it's not like you're trying to buy an ATV and claim that as a housing deduction for your farmland that you have. It's fair rental value. That one's a little bit tough because the furnishings inside your home are going to be the variable part. The rent, the utilities, the homeowners association, there's going to be some sort of dues or something that you're going to have to pay. All of that's pretty much set in stone. It's like, well, that's what they charge me. That's obviously the fair rental value. I'm going to then add on top of that what you have for furnishings. And we're going to have to, that's a conversation I have with my clients, kind of a one-on-one conversation of what's reasonable for furnishings. Let's try and figure that out. So it's not black and white on that, but that's a really common situation. So I think that's a good question. I think in most cases, it's just, if someone told me that they furnished their house with $35,000, I think we're pushing it, you know, if you're doing that on top of what you're paying in rent or, you know, all of that other stuff. But yeah, so just trying to do something that's reasonable though. Okay, housing allowance in retirement. In retirement, clergy still receive the benefit of a housing allowance. We kind of talked about this already, but your entire pension, UMPIP account is designated as housing, which is going to be exempt from federal income tax if it's spent on housing expenses. Okay, and within the fair rental value each year. So this can include purchasing a home plus furnishing the home. Biggest question that I get in this, and actually it might be. No, it's on a slide later. We'll touch on it again. But the biggest question that I get is, great, I have $200,000 in my UMPIP account. I was planning on buying a condo. Can I just take $200,000 out of the UMPIP account and it's all tax-free to go and I'll just pay cash for the condo? The answer is no, because we still have the fair rental value limitations. Okay, so a fair rental value of a place, maybe it's $36,000. That's $3,000 a month. Okay, if you took 200,000 out of UMPIP, you get to deduct 36,000 is tax-free. The other 164,000 is all going to be fully taxable to you. So that is one thing you want to be cautious of. Don't get real excited and cash out your whole retirement account in year one just to buy a house. Examples of housing. It's the same exact as when you were employed. Okay, nothing changed as far as what expenses are eligible. The example, I didn't talk about it in the previous one, but the example I like to use is, think about a short-term rental in the Wisconsin Dells. If you go rent a cabin for the weekend, what do you expect to be included in that cabin? If you expect it to be included, you can deduct it. Okay, so we think about, you expect the lawn to be mowed. You want the landscaping to look nice when you show up. You expect that cabin to look nice. You expect there to be locks on the door. You expect there to be a house, okay, to begin with. So windows, roof, any maintenance, that kind of stuff. You expect there to be couches, artwork. You expect them to have some form of entertainment, right? You expect that could be your whole VHS collection. That could be Netflix. That could be Amazon Prime. That's how we get our entertainment. Okay, you expect something like that. That all counts as housing, actually. So oftentimes, if you're trying to come up with what is some more housing stuff that I might not be thinking of, I think that's a lot of it, is you expect there to be some sort of form of communication. So a telephone, okay, you got to think about when the IRS wrote this tax code, okay? In that day and age, you would expect that there would be a phone in the cabin that you were staying at for kind of emergencies and that kind of stuff, just way of contacting. So your cell phones can count as housing. Your internet can count as housing. Now, you got to be kind of cautious with it too. If you're an employee, because oftentimes even in your split year, the year you do retire, you can't double dip on any expenses. So if you're an employee, you can't deduct your cell phone or your internet as like a unreimbursed professional expense and take it as a housing expense. You only get to deduct stuff once. Okay, yeah.
3 questions. First one's for me. So say in retirement, you own your own home.
Mhm.
And you need a new roof for $20,000. Can you, if you plan it for the next year, add that to your exclusion?
So the question was, if in retirement you end up needing a new roof on your house and it's going to cost you $20,000, can you just plan for it appropriately and add that to your exclusions the next year? The answer is, as long as it fits within the fair rental value. That's going to be your catch with that one. $20,000 on top of, and it depends. When you get to retirement, you may not have a mortgage payment anymore. Okay, so if you don't have a mortgage payment, it's not like you have this $1,500, $2,000 a month payment that you're paying every month. That's like, hey, I know I'm going to spend $30,000 in housing. That's easy. It might not be as easy in retirement to come up with those. So fair rental value is going to drive everything though. So ultimately, if it's $3,000 a month, I use $3,000 a month just kind of as a generic number. I think it's pretty safe to say that if you rented a fully furnished house, single family home in Dane County, you're going to spend more than $3,000 a month probably. So I just use 3,000 as kind of a generic number. Anybody who's online, I don't know where you're at. If you're way up in the Northwoods, it's not going to be $3,000 a month. Okay, so but a roof's not going to cost you what it does in Dane County either. So expenses are going to be, kind of aligned to where you're at. Other questions?
All right, 2 more questions, both from Jake's, one retirement specific, one not. How would housing allowance either work or not for someone like me that carefully looks forward to spending my retirement years in Africa?
Question is, how does the retirement or how does the housing allowance work for someone who is planning to spend their retirement years abroad? Okay, so first of all, you have to look at your primary residence. So, and I only give this as an example. It doesn't sound like your situation, but many individuals, okay, if you're traveling and you're just traveling for 5 months, or even maybe you're traveling for 10 months, it doesn't mean that you changed your principal residence. Your principal residence is determined on where do you plan to come back to, okay? In terms of international tax advice, I'm going to pass on that. If you are planning to move permanently, or even for 10 years, or you just an undecided amount of time, you're planning to move overseas, international tax code is going to be very complex in terms of the planning opportunities. I will tell you that you should still qualify for a housing allowance in some way, shape, or form. But I would recommend that you go to an accounting firm that is a larger accounting firm that's able to handle the international questions. So I get that question from clients occasionally. We don't work with enough international individuals to be well educated on those questions. So I always push you to find a CPA firm that's a large CPA firm. Like in Madison area, I would tell you work with Baker Tilly. Okay. I don't have any reason to recommend them other than they are a large CPA firm. They are an international company. I know they have the staff and the resources to be able to support those questions. But if you're moving abroad, the bigger concern is, okay, do you have to pay tax in Africa? I don't know. And whether or not you do have to pay tax in Africa is going to determine how you pay tax in the United States. There's all kinds of exclusions. You're not going to have, you won't be double taxed in most cases. So that's the good news, but it's just determining, okay, are you paying tax there? Are you not? So I'd recommend you go to a larger CPA firm and make sure that you're kind of planning everything ahead of time there.
And then this last one is from James as well. My spouse and I file a joint tax return each year. She pays all required taxes through her employer, while I, as a pastor, I use a different form of paying my taxes. How are such differences reconciled during our annual tax filing? And how does that impact our individual tax records and eventually our retirement?
So the question is, if you file a joint return and your spouse is paying all of their taxes through withholding, through their employment, and you are paying taxes in a different manner, maybe estimated tax payments, or it would be estimated tax payments, or it would be withholding, either one of those. How does all of that get reconciled on the tax return itself when you go to file a joint filing, but you kind of are paying your taxes in two different manners? There's two different ways to pay your taxes on the tax return, and you're going to report how much you had withheld from your paychecks, from your IRAs, from your Social Security. All of that's going to get reported on the tax return as withholding. And then you're also going to report how much do you have in estimated payments? How much did you pay in? You're going to report all of that on the tax return, and it'll all get thrown together on the same tax return, and it all gets reconciled on the same form together. Okay, so different types of housing that qualify in retirement. This is a common question we get too. You can purchase a home, you can rent a home, but even beyond that, you could have a travel trailer or a boat. Technically, you could. The big important part is it has to be your primary residence, okay? And you can only have one. And it has to include a bathroom for it to be considered a home. Okay, it's kind of really unique that's so if you have a boat, you need to have a bathroom on that boat. And honestly, I'm sure there's plenty of people who have done it. You could buy a pretty large sailboat and just decide to go sail in the Caribbean for a year, and that could be your primary residence. I have had an individual who has decided to get like an RV rental. And they decided to travel to the United States, and they considered that to be their primary residence. The tricky part with considering it to be your primary residence, if you have another primary residence that you plan on going back to, that's the tricky part. This individual didn't at that time. They had a lot that they rented, which they planned to go back and park it at that spot, and that was going to be their primary residence. So you can get kind of creative with this depending on what you want to do in retirement. So how much can the housing allowance be? We've kind of been over this a couple times already. So just a reminder, you're not able to just cash out the entire UMPIP account each year. Yeah.
There's two other retirement accounts that most people have money coming.
Okay.
They're going to be getting payments from these other two plans, and all of that money together can be considered for the housing allowance exclusion, particularly for people who don't have a lot of years in. You know, that they would have the CRSP, which has a defined benefit and a defined contribution. So all of that together, it's not, I just want people to know it's not just from your UMPIP.
Okay.
But they want to make sure they don't transfer too much out of their UMPIP so that they don't have enough money left for the housing allowance.
Yep. So Jane just brought up a good point too. Just these are some of the, I'm not in the conference constantly, so I don't necessarily know all of the terminology and everything. So as a pastor, you typically have 3 different accounts. You've got, and so when I mention UMPIP, it is not exclusively UMPIP. It is all of your retirement accounts that are going to be aggregated. They all count for housing. You're going to have a decision on how much you want to kind of pull aside from the UMPIP. You want to make sure that this is a really important part. If you pull money out of UMPIP and say you're working with a financial planner, say you're working with a financial planner who works with any company in the area, it doesn't matter. And they say, hey, I think we should manage your account in an IRA. We're going to have more investment options. We're going to be able to just do a better job managing it outside of these accounts. You lose your housing benefit if you move it outside of these accounts. Okay. So absolutely, you do not want to be moving this outside to an IRA. And if you have someone recommending that you do that, I would be very, very cautious, because what this account offers you is tax-free money. Depending on your tax situation, maybe it doesn't matter. Maybe you're already paying 0 tax and you will regardless. Okay, if that's the case, I guess maybe it doesn't matter if you move money out. But what if you're in a situation where you're in the 32% tax bracket, plus state tax is another 6%, so you're paying 38% tax? If that's the case, you're guaranteed to save 38% by keeping it in the UMPIP account. So you need to be really cautious. As soon as you move it outside, you have to pay tax on that entire account. So, Jason?
All right, another question. This is from Crystal. I purchased my mobile home this year. It is my primary residence. How is that handled when I use my UMPIP account?
So the question was, if you purchase a mobile home this year, it's your primary residence, how is that handled? It's going to be, if that is truly your primary residence, it's going to be handled just like it were a regular home. Like it doesn't, there's no distinction there at all. So any money that the purchase price of the mobile home, any ongoing payments that you have, utilities, furnishing the home, all of that qualifies. You're just going to have to come up with a comparison to figure out what's the fair rental value of that place. And that's going to be your limiting factor. A lot of times, even if you're talking a down payment, the mobile home is actually a really good example, because you might be in a situation where you say, great, depending on where you're at, and you might be putting more down on it, okay, just to make sure that your payment is a little bit lower. Okay, well, you got to be cautious with how much you're putting down, whether it's mobile home or whether it's a condo, a townhouse, single family home. you kind of want to pump the brakes a little bit on putting a huge amount down on these properties, because you are going to cap out what you can use for a housing allowance, especially in year one. That down payment, if you put 60,000 down on a house, fair rental value is probably not 60,000. So you're going to be limited as far as what you can actually take for a housing allowance that year.
All right, another one.
Yep.
From Loretta. If I have another, I think, 401k, it's through TIAA crap, I don't know what that is, through a previous employer, and it has more money in it than my UMPIP. Should I consider transferring that account into my UMPIP because of the housing allowance? Is that even possible to do?
Great question. The question is, if you have a separate 401k, in this case, held at TIAA CREF, it's a custodian, just like if it were held at Fidelity or held at Charles Schwab. In that case, the question is, can I take that account and roll it over into the UMPIP account in order to basically make the UMPIP account larger and basically make everything eligible for housing? So the answer to that question is, I think you could get away with that. I don't think that is correct. I've looked and looked and looked to see if that is actually legitimate, that you can do that, because I've wanted to do that for individuals. But the IRS is clear that the housing allowance in retirement, in order for that account to be eligible, the funds need to come from your service as a pastor throughout your career. Those funds from TIAA CREF are not from your service as a pastor, so I do not believe that those would be eligible. The reason why I kind of jokingly say I think you could get away with it is you could roll it in there. No one would know any different. I do not think that it is correct, though. I've never done that for a client, and I've searched and searched to see if I can get someone to like back me up on that in the industry, and I can't find anyone who's done it, and I can't really find a yes or a no, but everything that I know about the tax code is no, that I would not do that. I'd be very hesitant to do that. I don't think that's what it's designed for. My follow-up question to that would be, are you fully retired? Or, which you can answer in the chat. Are you fully retired, or are you still working as a pastor?
He's still working.
Yep. So if you are still working, depending on how many years you have left, my suggestion would be you should be maxing out UMPIP every year, even if you can't afford to. And how do you do that? If every year you can put roughly, I don't know what the new limits moved to, but they moved something like $27,000 a year that you can put in to the UMPIP account. I would recommend you put $27,000 in, and you say, James, I can't do that. I won't have any money to live on. Then you send yourself paychecks from the TIAA CREF account. So in essence, what are you doing? You're transferring $27,000 a year from the TIAA CREF account to the UMPIP account and making that eligible for housing. And in the meantime, when you take money out of the TIAA CREF account, you are paying federal and state income tax on it. Okay. Pay federal and state income tax, move it over here. When it goes into the UMPIP account, you're going to save federal and state income taxes and self-employment tax on it. So what are you doing there? Overall, you're giving yourself a 15% tax break, and you're creating tax-free income in the future. So you're making 15% to not pay tax on this ever.
He says he's retiring this June.
Yep. So I would say whatever you might possibly be able to put in, it's worth it. Anything that you might possibly do, completely max what you can for the first portion of this year. So that would be my recommendation in that. Yep. So, and Jean's mad at me. So. I said, and Jean's mad at me, causing more work. Yeah. Okay. How do you determine the fair rental value? In case anybody wasn't here for the first section, basically IRS doesn't give any specific way to come up with the fair rental value. We recommend that you talk to a realtor, get a letter from a realtor. They're going to give you a good idea. Otherwise, hop onto realtor.com or Zillow and just come up with comparable prices for stuff that's renting in your area. We have a worksheet for planning. This is a worksheet basically just to help keep you organized. It's really small here. We're going to get this available electronically for anybody online. And then we also have copies for everybody in the room here. Basically, it's just the top section is how much you actually spent. So it's got categories of everything that you can include. It's not a fully exhaustive list of what you can include, but that's where you can put what you actually spent. Then you put total housing expenses paid, put that in that line, total amount designated for the housing allowance. Well, if you're retired, that answers everything, 100% of whatever I took out of the pension. It's all designated. And then last one is valuation test. We just kind of give you a section here and recommend to use a realtor, but if you're doing comparisons, you know, house A, house B, house C, just throw in your estimates for what those are going to cost. And then you just take the lowest value, and that is lowest of the three. Goes down here at the bottom, and hopefully that's helpful to keep you guys organized too. So okay, so similar example to what I had in the last one as well. Pastor Ann owns her home. She receives a pension of $30,000, which is fully designated as housing. She spent $21,000 on mortgage payments, furnishings, utilities. The fair rental value of the home is determined to be $24,000. So the answer in this case is you're going to take the lowest. So she can exclude $21,000 from her income tax. That's the lowest of those. So what she actually spent in this example is the lowest, $21,000, which is what I would want it to be. You know, that's in this case, we weren't limited by what was designated because everything's designated. Okay. Weddings, funerals, honorarium income. So this is treated exactly the same as if you're employed. Still going to a Schedule C. You're reporting the income as self-employment income. You're deducting expenses and got to pay tax on that. So qualified charitable distribution. We talked about that on the last one a little bit, but if anyone has future kind of more questions on that, you can let me know. These are all examples. Okay. So questions. These are actually some common questions that we got throughout the year last year too. Did you have something, Jason? Okay. So some of the common questions that we get: what happens when the retired clergy passes away? In this case, easy answer: the housing allowance is tied to the pastor. Okay. So if you have a married couple and one of them was a pastor and they pass away, the surviving spouse does not continue to get a housing allowance. Goes away. Okay. That's really important because especially in retirement, you will be shocked how big of a tax difference there is. I have had individuals who have gone from paying zero tax every year. Their income dropped because they now only receive one Social Security. And now they're paying $10,000, $12,000 a year in tax in retirement. Okay, it's just kind of wild how big of a difference it can be. So it's more of just a heads up of and a good encouragement to fully utilize that account. You know, if you have two different accounts, got a married couple, the pastor has an account, and you're trying to, and also the spouse has an account, and you're trying to decide where do we pull money from. Well, if it's for housing, make sure we're taking it from the pastor's account. We want to get that out tax-free while we can. Yep.
Is there a form to support line 5B?
No, there is no form that you submit. So the question is there, let me go all the way back up. Let's go all the way back up here. So the question was, is there a form to support line 5B? So 5A is the total distribution from that could be a pension, that could also just be additional distributions from your retirement account. There is no form to support that. So there's really no designation. You can attach a note to your tax return if you wanted to. We attach it's called an unformatted statement. It's not required, it's not necessary, but I just include a note saying, this is why we're not treating the entire IRA distribution or pension distribution as taxable, just to give the IRS. I've never had an issue either way. Never had the IRS question it, even when I don't say that the entire amount is taxable. So no form to support it. Just keep your records. If the IRS ever comes back and asks you, you should be able to type up a letter back and give them proof of expenses, and it won't be really a big issue at all.
I can't read that. Is that the housing allowance?
No, this, yes, the difference between 30,000 and 10,000 in this case, yep.
You do have, what a lot of people want is a copy of the resolution that was passed at annual conference.
Okay,
And those are on the conference website. You go to the health and pension area and look for retirement resources. They're all there for the last 3 years, including this year and next year.
okay.
As soon as it's passed at annual conference and we get the final format, it's there for people to get.
Okay, so Gene was just mentioning that if you're looking for the resolution showing that the entire pension is designated as housing, that is on the conference website under the health and pension section. And so it's under retirement resources. So all of the years should be in there and available for you to get that online.
Look, here's another question.
Okay,
Can you instead put the amount as a negative other income amount with the reason listed housing exclusion?
question is, can you, instead of just subtracting the amount on line from line 5A, 5B, can you do a negative other income adjustment with an explanation of this is a housing exclusion? Could you do that? Yeah, you could do that. I would not recommend that though. If you put a negative on other income, that is far more likely to trigger a question from the IRS than just including a difference in the numbers on 5A and 5B. That's certainly from our experience. Anytime the IRS sees a negative on a line, especially other income, because if it's a negative, doesn't sound like income. So that's just more likely. I put a negative on that line in some cases when I need to in some very, very kind of messy situations where I just have to, I'm trying to get to the correct bottom line more than anything. But in this way, the IRS instructs us to just subtract the difference between line 5A and 5B. Okay, the other one, moving reimbursement. This one's important in the year of retirement. So just kind of more of a FYI. So conference is going to pay for your moving one last time if you're moving. So one thing just to remember, you're going to get a 1099 for the moving reimbursement. So let's just say that you get moving costs you $3,500. You get a 1099 for $3,500. You have to pay tax on $3,500. It used to be really, really simple. You always got this form. It used to be simple because you could just deduct moving expenses and subtract $3,500 off of your return. You don't pay any tax on it. In 2018, part of the whole tax overhaul, they got rid of the ability to deduct moving expenses. but you still have to report the income. So we lost the deduction there. The important distinction here is that it is actually considered self-employment income too. So you should be putting this on a Schedule C, and this should be subject to federal, state, and self-employment tax. The biggest reason why we classify it as self-employment tax is because the conference is using the moving reimbursement to calculate what they're paying in to the pension on your behalf. So because of that, it is considered earned income. You can correct me if I'm wrong, Gene, but that has been my understanding from prior years.
That's what happens for people who are active. Once people have actually started their retirement income from WestCat, they don't get additional retirement income.
So do you know in the
You still, you still can't deduct the moving expenses, because the only people who can deduct moving expenses, I believe, are military.
Yep, but in this case, I guess my question for you would be, are they on the final moving reimbursement, are they getting an adjustment to their pension? Okay, so change the slide. On your very last moving reimbursement, you may have moved prior, and this is how it should have been treated. If you moved prior, you will still get a 1099. However, in the 1099 case, my recommendation for how to treat this on your tax return is that it should not be subject to self-employment tax, because your final moving reimbursement, the conference does not pay into the pension on your behalf, so it's not earned income. My suggestion would be to put it onto a Schedule C, subtract it off of a Schedule C as an expense, which moving expenses are not allowed, but my recommendation, subtract it off, and then put it on as other income on line 7, I believe. Yeah, I'm not sure what line it is specifically, but it should just go on like an other income line, and then just state it's moving reimbursement. The reason why I suggest you do that is I'm trying to get you to pay the correct amount of tax while avoiding a notice from the IRS. You have to put it onto a Schedule C because the IRS is looking for it on a Schedule C. Anytime the IRS gets a 1099, they look for that income on a Schedule C. So that's why I put it onto that. They only look at the very top line of the Schedule C though. They don't look at the expenses. So put it onto a Schedule C, subtract it off, and then put it where it does belong. So the only reason we're doing anything with the Schedule C is to avoid an IRS notice. It belongs on other income. You're going to pay federal and state income taxes. You don't need to pay self-employment tax on that.
And only people who are serving local churches get a move fee.
Okay, and Gene said only individuals who are serving local churches are going to get a move paid for their final time. Okay, so year of transition, withholding versus estimated payments. I mean, my preference is for you to pay estimated payments for the year of transition, just because there's a lot going on there. It's really hard to get your withholding set in that year of transition. You can do it through withholding, but I think estimated payments are probably the best. And after that, it's just your preference. The benefit of withholding is that you kind of set it and forget it. So you can have Social Security withhold 12% from your paycheck and just, if that's correct amount, great. It might take you a little bit of trial and error to get to the right number, but once you have the withholding set, you're good to go. You don't really ever need to worry about it again. The estimated payments, they're easier to adjust because all you have to do is just change the payment that you're making. So estimated payments, you pay 4 times a year for anybody who doesn't do that. And it's just, all it is, it's just you send a check to the IRS 4 times a year. You have to remember to do it though. That's the thing, is you got to remember, oh, when is that due again? And sometimes you forget estimated payments and then you got to make it up later. So that's the downside to the estimated payments, is just trying to have to remember it. But benefit is they're easier to adjust if you had any change in your income. And that's all I have for the retirement and a section of it. So any other questions from anybody?
Regarding social security tax, once you are mandatory, you have to take the social security.
Yep.
That is 72, you said.
70 for Social Security. Yep.
Then after that, still you work, continue to work, still you contribute to social security then?
Yes, good question. So question was if once you are required to start drawing Social Security as a benefit, which the latest you can wait is age 70, at that point you're required to start drawing Social Security. Do you still have to pay into Social Security if you're drawing it? And the answer is yes, you do still have to pay into it. And it depends on your circumstance, but it's very likely that your additional work will increase your Social Security benefit. So you'll continue to get raises based on your additional that you're paying into the system. So in some cases, it won't make a difference. You still have to. Way that Social Security works is that it takes your highest 35 years of earnings. And so if when you're 71, you're working and you work a year that is not one of your highest 35 years of earnings, it won't have any effect on your benefit. But if you say you made $50,000 for 35 years, 50,000 exactly, and at age 71, you make 60,000, it's going to get rid of one of those years of 50,000, replace it with one for 60, and then it's going to increase your benefit that you're drawing automatically.
So do we have to claim after that? What I'm saying is 70 years age, you are mandatory required to withdraw benefit, then you contribute. Then after that, your benefit might increase. Should I claim that, or they will automatically increase your benefit?
They will automatically, yep, and the benefit will be adjusted automatically.
But that's a good point to check your earnings record.
Oh, yeah. So just that is a good reminder, especially for pastors, because you are self-employed. The communication for your Social Security, for your Social Security earnings record is done through the tax return, which means that you report on your tax return what your income was. The IRS then sends that information to Social Security. You can go to Social Security's website and set up an account, and everybody should do that just to verify your own earnings. There are plenty of times that I've seen where someone's earnings show up as 0 for the year. They didn't give you any credit. Okay, if that's the case, you need to reach out to Social Security and just tell them that there's a mistake, and they'll get that updated for you. So, Jason.
So then my question is, do we look for our federally taxed earnings, or is it what they tax us? So which one of that?
Yep.
Matt?
So good question is, what number are you looking for on Social Security's website? Are you looking for your federal income tax number, as far as what's subject to federal income tax, or are you looking for what's subject to self-employment tax? And the answer is you're looking for the number that's subject to self-employment tax. Yep. And that's one of the whole reasons why the housing allowance is not exempt from Social Security and Medicare tax. It's exempt from federal and state income tax, but not exempt from Social Security. Is if they gave you that exemption, your Social Security benefit would be very, very low at the end of your career because you got that exemption throughout. You wouldn't be paying that much in Social Security tax. So they want you paying in to make sure you get a good benefit.
I have another question here. If you ask a realtor for an estimate of your fair rental value, should you ask them to also include a figure for the fair rental value of the furnishings and an amount for the monthly utilities? Example, if rental value is $1,500, utilities average 300, and you suggested earlier about 1,000 for the value of the furnishings, the monthly estimate would be $2,800 per month.
The question was, if you're asking a realtor for a written letter just indicating the fair rental value of a home, you should be requesting that they give you an estimate of a fully furnished one. So And then you gave an example in the chat as well. I would say you should ask the realtor for a better number than the $1,000 that I told you. So the realtor should give you a more accurate number for that. But yes, your example is exactly correct, where if the realtor says, because sometimes you might see it where the realtor says, I have nothing to base this off of. I don't know what a fully furnished place is worth. So here's the value of an unfurnished place. Okay, then you add in the $1,000 a month or whatever it might be for furnishings. Yep.
I have brought some papers to show you what you have said earlier about social security, saying that no contribution on that year, particular year. For me, it is 2018. It shows zero contribution. I have all the records here.
Okay.
And I contacted several times to the Social Security office, and they did not give me a real reason why they could not. They say, oh, we will update it. They took all the returns, everything, but they did not do that. But finally, they said, IRS did not send the figures to us, something like that. I don't know how to deal with that.
Okay, I'll help you afterwards
Yeah.
on that. Yep. Yeah. Any other questions?
So, thank you, James.
All right.
Cassandra, thank you, Colleen, for running the camera, and thanks everybody for being here.
Yeah, thanks everybody who's online, and hopefully it was helpful.